Welcome to the MedFavor Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
MedFavor is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Full on into summer. We got a fan favorite back on the show. Today, we're joined by Bob Elliott. Bob is the CEO, CIO of Unlimited, which uses machine learning and all sorts of other magic to create low-cost index replicators of old school 2 and 20 and more style alternative investment strategies. Prior to starting Unlimited, Bob served as the investment committee at Bridgewater Associates, where he built and led Ray Dalio's investing research team for almost a decade. Bob, welcome back to the show.
Thanks so much for having me. Excited to be back on.
Give us Bob's neighborhood TikTok summary. What's going on in the world? Macro. You can take that any way you want. You can talk about growth, inflation, interest rates, liquidity, dollar. Take your pick.
Usually I hold myself to 60 seconds because no one watches beyond that on TikTok, but here I'll do. I think we've got an audience that'll listen at least a little bit longer than 60 seconds.
Yeah, this is like Rogan style. Our most popular episodes are the ones that are the longest. So
yeah, there you go. So taking a step back in terms of the macro environment, like we have been in a late cycle. We are in a late cycle environment, by which I mean the economy has grown for a while. The unemployment rate's relatively low. There was inflation pressures. The Fed tightened, and that has, on the margin, moderately slowed the economy. And sort of absent any negative federal government policy, my guess is this would have been a pretty boring year, highlighted probably with a little bit of AI boom to it and keeping the economy basically where it was, the last couple of years, which is growing, 2%, give or take. I think what we're seeing this year, which is meaningfully different from what we've seen the last couple of years, is a set of significant negative growth policies from the federal government, the two biggest being the constraint on immigration and the implementation of the tariff policies, which when added together represent something like a 1.5% to 2% max negative GDP effect that will probably peak either the fourth quarter of this year or the first quarter of next year. And that basically is a big drag that we're already seeing flow through to the economy. And as a result, you'd expect basically considerably weaker growth. And with it, given the current expectations that exist in both the stock market, basically at all-time highs, and in the long end of the bond market with real yields and nominal yields basically at cyclical highs, you'd expect those markets to reflect the weaker economic conditions ahead. We had, I'd say, a moment of that earlier in the year, but that's largely been reversed with stocks going back to highs and bond yields still remaining elevated. And so we haven't really fully or really hardly priced in a weaker growth environment, despite seeing in the macro data pretty clear weaker growth trajectory in place already and likely to get even weaker ahead.
I mean, this tariff situation is playing out as like a real-time macro playground experiment almost. It's something that I feel like I look at economists and they come up with 1,000 different beliefs as economists do. How do you kind of think about, now that we've had a handful of months of tariffs starting to roll in, how do you think about them in general? Is this something that you think is going to have some major impacts on asset prices? And if so, how?
What we're seeing right now is, with the tariff policy, is one of the greatest macroeconomic experiments of our lifetime, right? Never before has the world's largest economy implemented the highest tariffs in 100 years over the course of weeks. And so I think there's a lot of uncertainty about exactly how this is all going to flow through. Tariffs, of course, are just a tax, and that the economic consequence of that tax can be absorbed either by the foreign producer, the domestic wholesaler or retailer, or the consumer themselves. And so given the uncertainties, of this, sort of classical economics would say that mostly the onshore consumer absorbs the effect. And some small scale tariffs, like things like the washing machine tariff that happened previously, largely confirmed that dynamic. But given the scale of this, it really is an empirical question rather than a theoretical question. And so we're just now getting into getting the empirics to be able to see this. And I think the main things that we see are, one, that foreign producers are by and large not absorbing the tariffs. And we can see that from the fact that pre-tariff import prices have actually risen. If the foreign producers were absorbing the tariff, their prices before the tariffs would actually need to fall in dollar terms, and if in fact they are rising. So it's mostly not, by and large, not being absorbed by the foreign producer. And so the real question is, who's absorbing it on the U.S.? Is it the businesses, or is it the consumer? And so far, like many sort of shocks like this, businesses are initially absorbing the majority of it, but we're starting to see it bleed into consumer prices, particularly in things like durable goods, et cetera. And so probably what we're seeing is, over the course of the next 6 months, a transition to basically the U.S. consumer bearing most of the burden, not entirely, but most, and with it basically creating a drag on their real spending power. Because, unlike what we saw back in 2022, or during COVID, where there was a big supplement to incomes or strong nominal income growth, here we've got weakening nominal income growth and rising prices, the combination of which is likely to create weak demand at a time actually when demand has already been pretty weak. And ultimately, the U.S. economy comes down to households to consume. Like anything that happens in the economy, ultimately either the households or the government has to consume and the endpoint. And so that's going to be challenging to keep growth anywhere near expectations, given the drag that's likely to come on households.
Have we started to see any stories yet? I feel like, just looking at the popular media, is there any outrage of any, particular corners of the world where people were losing their minds about prices of XYZ? Because I feel like you would start to see it like pop up in some areas. Is there anything happening yet? Is there any outrage over French wine or, washing machines from Taiwan or what? Anything or not so much?
Well, I think the first order, which we've already started to see a lot of complaints on, are really small businesses with single source supply factors. So, someone with a young kid, I followed the baby supplies and toys, et cetera, market a little bit. And there you've got a lot of small Amazon sellers who are basically sourcing in China and are faced with very high tariff rates that they never expected to have and are struggling with whether they pass it along or not, et cetera. And so they're really feeling squeezed, in particular because they got to pay the tariff essentially immediately, and then they got to deal with the price consequence down the line. And so we're really seeing a squeeze on small businesses who are most affected by it. When it comes to the consumers, it's interesting. It's the sort of thing that crops up in various corners, like tomatoes, as an example, right? So I was listening to another podcast discussing making pizza, the economics of pizza in New York, and they used imported tomatoes from Europe and are seeing those prices rise as a function of the tariff policy. Not the place that you'd think would matter, but it's the sort of thing that it kind of seeps into every little nook and cranny of the market. And then, they have the choice to either get squeezed or pass along to the consumers, and slowly but surely menu costs are rising.
We've had this start to the year where this has got to be one of the worst starts ever for the dollar for 6 months. And so how is that playing into kind of how you're thinking about assets in general? Is it kind of trying to adjust for some of the inflationary scenarios going on, or what's happening with the dollar?
I think the dollar, for those of us who follow the currency markets, you sort of see these big cycles, particularly in developed world currencies, that play out over something like 15 years, typically 10 to 15 years. And it's the sort of thing that is slow moving enough that people don't notice the turns and then eventually take the trends for granted, and therefore sort of position in a way that gets burned as it reverses. And I think that's basically what we're seeing here. Like post GFC, the dollar was at secular lows. And the US obviously had much better stimulative policy and better managed economy than places like Europe and others coming out of the GFC. And that kicked off essentially 15 years of a boom in investment in the US. And there was always some story about it, whether it was, quantitative easing supporting US stock prices, or whether it's an AI boom, or all, that was sort of the last thing was the AI boom. Basically, what we got to was a point something like 2 years ago where the US was absorbing something like 70% of every incremental dollar invested in global financial assets, which obviously is extreme relative to the productive capacity of the US economy, or even the companies in the publicly traded companies. And so that's the sort of thing where just the shift from no longer allocating 70% of the capital to the dollar or to US-based assets to even something like 60 creates a big shift in the capital flows and the demand for those assets. And as a result, starts to sow the seeds of the reversal. And that's largely what we've seen here. Now, people will point to sort of specific flows data and say, oh, well, it looks like foreigners aren't actively selling U.S. assets. That's true. But one of the things that they are doing is they're shifting from an environment of passive, unhedged positions, particularly in equities, to starting to increase their hedges for the first time as the dollar has shifted against them, meaningfully against them at the beginning of the year. And so we're seeing a lot of folks who sort of took dollar currency appreciation for granted, or sort of weren't even paying attention to it, just enjoyed the benefits, are now faced with the consequences of having large overallocated positions in U.S. assets that are unhedged and are starting to shift back. It's not the sort of thing that's a great bet or a great Sharpe ratio over a 6-month time frame, because these things go up, they go down, et cetera. It's the sort of thing that if you're thinking about a strategic 15-year allocation, where you have to start to really look at and say, do I want to be overweight U.S. assets in this environment, or do I want to be looking towards global assets in an environment where the dollar is likely set up for a longer-term depreciation event?
You think on a kind of valuation, purchasing power, dollar is back to normal, still expensive, cheap? What do you think?
The move is relatively inconsequential relative to the magnitude of the overvaluation of the dollar. I mean, we were at essentially secular highs as recently as a few months ago to start the year. And so sure, the dollar's down, 5 or 10% from that point, but that is pretty trivial relative to the sort of moves we typically see in these longer dated cycles that can move 50% or more. I mean, it's not, I think people forget, like, the euro traded in the 140s, and now people see a 10-cent move and think, oh, wow, the dollar fall is over. It's like, no, these things go on for significant periods of time and typically represent really large shifts in relative purchasing power between different economies.
Yeah. While we're on the topic of kind of assets in general, dislocations, as you look around the world, what are the things you see that you kind of shake your head at and say, this is a big risk, this is a big opportunity, this looks out of line? Anything stick out, or everything look normal? Does everything ever look totally normal? I mean, has there been a time where it's like, everything actually just looks fine?
Sometimes things are boring, mid-cycle,
fairly valued, and
2004, 2005, it was pretty boring.
Great vintage.
Before things ramped up. Those are the sort of times. When I look at the world, I think probably the thing that is probably the most interesting dynamic is just how much people hate bonds. And it's not surprising. Bonds have performed poorly. We basically have a lost decade in the bond market, and in particular in the U.S. bond market. And so I talk to advisors and other allocators all day, and every single one is like, why would I hold bonds? And the answer is like, well, actually, because, bond yields are pretty elevated, and bonds are largely trading as a, negative correlation to equity prices. And so, yeah, it's true, equities are doing well, but if you want any protection here, this isn't a few years ago when bond yields were at or near zero. and from a value perspective, didn't make any sense to hold in a strategic portfolio. We're now at a level of yields where there's meaningful diversification potential. And then you look at something like TIPS, where you're getting, mid twos to above in terms of a real yield. I mean, if I had to bet on an asset that's going to do well over the course of the next 10 or 15 or 20 years, like buying 2.5+% real yields is actually quite a compelling trade, given that it's essentially risk-free on a buy and hold basis.
We did a fun poll on Twitter. We asked people, we said, what is a real TIPS yield, at which point like you would just sell your stocks and buy TIPS. And like, I think people still wouldn't do it. I said up to 7%, which has never happened before. Late 90s, what was it? It got up to like 4 or something.
Yeah, 3 to 4 in the financial crisis. There was a liquidity squeeze, and it got. I actually bought some long dated TIPS then, close to the mid 3s, which was a hell of a trade.
Over half the people said a 7% or never as the real yield to buy TIPS and sell stocks. So that's a pretty good. I don't think we'll ever see that in my lifetime, but it will be interesting.
7% for sure not. I mean, I tell you, you think about it, at 3% real guaranteed, essentially, that's load up the truck levels in terms of buying TIPS, because on a risk adjusted basis, you're not going to do a lot better than that in any longer term time frame.
Lake Wobegon, everyone's above average, Bob. What was the most recent? Some of the there's a consistent poll every year. I think it was down, but it's still like 15-17%. Everyone's this long U.S. bull has conditioned people for the sky is the limit. So is it ever going to end? What do you think? As we look to U.S. equities, you mentioned kind of late cycle. We can talk about gold, Bitcoin too. A lot of stuff is hit new highs. What about any of those as you think about?
The sort of macro investor in me looks at this and says, it looks like pretty, in some ways, quite boring when it comes to like a late cycle environment, very, very normal. And what I mean by normal is like, basically every late cycle, the way it works is that there's hopped up expectations of what's going to transpire. And usually there's some bubble or some narrative or something that is, that's going to separate. This is the moment where, markets are not going to fall back to earth from a narrative perspective. And so that creates very elevated expectations just at a time when, usually some combination of Fed tightening, or maybe there's another effect in the market. In this case, it would be, federal government negative growth policies creates a slowing of growth. And then there's just a gap between, high expectations and weaker economic conditions. And eventually those things close. And of course, people talk about, well, bubbles can persist, for a period of time or longer than you can stay solvent. But what I'd say, if you go back, actually wrote about this recently on my Substack, if you just go back and look at all the different cycles, the economy cannot weaken without asset prices weakening, particularly stocks weaken, for that long. Like that divergence does not exist. It can exist for 6 months. It can exist for 9 months, maybe 12 months. But by and large, you don't see those two pieces diverge for long. Often you can see the bubble keeping growth up for an extended period of time, where valuations aren't that valuable, but aren't a valuable indicator, negative indicator. But once the real economy starts to slow, like markets will follow the real economy over time. Like markets are meaningfully driven, primarily driven by the real economy, and cannot diverge from the real economy for, all that long.
I was laughing because I see some of these headlines go by, and there was one where they're like, Vanguard says you should put 70% in bonds. And, you kind of click through, and Vanguard has this for valuation aware investors with the requisite risk tolerance. And it says you used to have a 60% US, 40% fixed income. But I was laughing not because of the time varying asset allocation of the stock side, like whatever, 60-40 to 30-70. It's that within the 70, they say 20 percentage points of that is international bonds. And I'm like, I don't know a single US investor, particularly pros, that allocates hardly anything almost ever Like forget, like they may buy some foreign stocks, may buy some emerging, but international bonds, like it's almost never. Has that been your experience? Maybe some of the institutions, but the average financial advisor, I don't know if I've ever seen a portfolio that has certainly not 20 percentage points in international bonds, despite being arguably the largest asset class in the world, right? If you aggregate all of them. Any thoughts?
Yeah. I can remember about 10 years ago talking to a number of investors about Chinese bonds, at which point they looked at me like I was a crazy person. I followed up by talking to them about gold, which, the combination of which made them look at me like, who is this fellow from the asylum that they've let out talking about all this nonsense, these nonsense assets that are out there in the world. And I think the reality, no, I don't really hear basically any advisors or allocators really talking about global bonds. The truth is, developed world global bonds aren't that interesting, particularly on a currency hedged approach, because there's very high correlation between the U.S. Treasury market and a lot of these other markets. Not 100%, but it's pretty high, particularly on a currency hedged basis, because there's, if you're gonna hold these bonds, holding them with currency risk, the currency risk swamps the bond risk, and so you don't actually get that much. You don't get that much diversification. The place that's kind of more interesting is opportunities in emerging economies where there can be more meaningful divergence. I mean, just think about places like Brazil, where you're, even on the long end, you're getting meaningful yield that exists in those markets, or Mexico, et cetera. But that's pretty out there in terms of different things that people could invest in, pretty unfamiliar. And, you really have to sort of stretch to the outer bounds of where you can find assets to get something that, at least in the bond market, is diversifying enough to make sense to go buy. So Vanguard's probably right, but no one's going to do anything about it.
It's just funny to see Vanguard talk about market timing like that, which is, they're talking about a lot of stuff today that Bogle would probably be rolling in his grave. Private equity, all sorts of things going on over there. Anyway, all right. I want to talk about your funds a little bit. Last time we had you on the show, you were rolling out pretty innovative new idea. And I was trying to shiding you a bit. I was saying, Bob, let's get these other ones out. I want to see some of these ideas you got, particularly the managed futures trend one. Give us a quick overview. The first fund, HFND, I believe, the ticker. Tell me a little bit about that fund again, and then I want to hear about the next three.
Last time we talked, we had just launched our first fund, HFND, which, in a lot of ways was meant to be a proof of concept of our sort of overall goal, which is, using technology to basically replicate how hedge funds are positioned in close to real time, and then use that understanding to build products that make hedge fund returns available for all investors. And that first product was a combination of essentially replications of a bunch of underlying strategies tuned to basically track hedge fund index performance. And I think one of the challenges, I think we launched it on the day of the bottom of the equity market in 2022, before the best 2-year equity market performance in 150 years. So that was inopportune timing, particularly for a strategy that matched institutional hedge fund allocations, which are run basically at bond risk, right? They're meant to be a bond alternative. And so while HFND has done what it's supposed to do in terms of tracking and has outperformed bonds by a couple hundred basis points, which is basically what the goal is, particularly net of fees, I think a lot of advisors look at it and say it looks a little underpowered or cash inefficient relative to other options that are out there, particularly in a booming equity market environment.
I mean, look, nobody cares when S&P is doing 15% a year. Everyone's fat and happy. Like I said on this webinar I did earlier, I was like, why are any of you here? Like, it's summertime. The markets are at all-time highs. Like, you don't need to be paying attention to markets. Like, you guys should be out playing golf, surfing, watching Bob's videos on TikTok. Like, come on. Like, it's a bull market. I was like, however, it's when that eventually goes sideways or down or way down or whatever, where all of a sudden everyone gets religion again. But, it feels like everyone's kind of waiting for the game of musical chairs to stop. And they're just like, I'm good. And then here we are. So that may be this year, maybe 2030, we'll see. But at some point, the music ends.
Yeah, eventually the music ends. I mean, I think part of what I've learned in the last couple of years in talking to advisors is part of the way that you can be interesting to advisors, even when there's an equity bull market, is by, having a high enough target return on your products that it starts to, reduce the line item risk that they might take if they allocate to the products and sort of get the diversification benefits without having to worry about trailing equity returns too meaningfully. And so that's why this year we launched a couple of the underlying strategies that we had been running in HFND for 3 years now, and had shown that they can track what hedge funds are up to. But instead of taking them sort of out of the box at bond risk, we're running them closer to equity index risk. So essentially a 2x target return for equity long short, managed futures, and global macro. And I think when you start to look at those products at a 2x target return, they start to be on par with, or those returns have historically been better than that of the equity market and are diversifying. And so that combination actually starts to be much more interesting. And so, with our macro product that's been around for 4 months, we've been able to see pretty strong returns that are not that correlated to the equity market, and are strong enough to garner interest even in the middle of an equity bull market, which is certainly something to be said.
Talk to me a little bit about, for those who are listening and they hear, okay, Bob's talking about global macro, but he's also talking about hedge funds. Like, what's the main difference between these two products? I feel like most people know equity long short, right? They kind of get that. And then they've heard me drone on enough about trend and managed futures. They probably get that. But maybe macro and hedge funds, they may not say, like, what's the difference? Isn't a hedge fund, aren't macro, explain kind of the difference in the products, what they do, how to think about them.
I think about hedge funds in general kind of break down to 7 different strategies in general, which is strategies like equity long short, managed futures, which is like trend is part of managed futures, event-oriented strategies, fixed income, emerging markets, and equity long short, I think I didn't say. But you basically kind of break the whole hedge fund universe down into those different buckets. And each one of those different buckets basically has a different return profile. So for instance, equity long short managers, they generally, particularly sort of if you average the performance of all the major equity long short managers, they generally keep up with equity markets as they're doing well, but are really good at protecting on the downside.
While we're there, is there a target like you kind of think of? Is it like 150 long, 50 short, 100 short? Like, is there sort of a target beta or exposure that you think is representative of the long short category, or does it vary?
Most of those strategies run at like an 0.4 or 0.5 beta because they're targeting bond-like returns. And so they run about half the risk of equity index returns, so more like 0.3. And so the challenge with that is that they also run at half the return and have high fees. And so you add that up and they kind of look crappy for equity long short. But interestingly, if you add back the fees, so you don't charge the exorbitant fees that they charge, and you raise the target return to 2x, you actually start to get a return with those strategies that I'd say is quite compelling relative to the vast majority of actively managed equity products that are out there, particularly in the ETF wrapper. I wrote a blog piece on that recently where I just compared, equity long short funds, equity long short hedge fund performance at a 2x target return and 95 basis point fee, higher return, lower fees, to the top 50 actively managed equity ETFs that are out there. So things like ARC and, all the different dimensional funds and various things like that. And you see actually that equity long short managers, if you can lower the fees and raise the target return, do very well, basically outperform across a wide variety of different measures, basically everything that's in the ETF wrapper. And so that's why, even though people kind of, are kind of like, equity long short, who cares? Isn't that compelling? They're just they're not thinking about the quality of the return profile. They're thinking about the returns that they see on the screen, which is not what the manager sees, for instance. And so that's really the benefit of those sorts of strategies. I've gone on about equity long short. We haven't really talked about macro, which as you say, is interestingly like a bit of an enigma for most folks because there isn't a lot of true macro strategies out there in the world that the everyday investor can get access to. Like a lot of funds kind of position themselves as macro, but they're really trend type funds, or they position themselves as macro, maybe they're tactical asset allocation type products. But sort of true macro, and what I mean by true macro, I mean is like long and short positions in the 30 or 40 largest liquid markets, currencies, commodities, fixed income, credit, equity indices. There's not a lot of products that are out there like that. And advisors always ask me like, okay, so what's a competitor of your macro product? I'm like, not a lot. It's the reality. Yeah. Certainly not a lot in the ETF wrapper. And so I mean, the thing you can sort of think about with macro, I like to think about macro to borrow a term from a previous life. I kind of think about macro as kind of all-weather alpha. And part of the reason why that is because, the fact that they can invest in a wide range of different assets, long and short, actually has some of the defensive properties that things like trend have, because macro managers can essentially trend follow negative market environments when they emerge. But it also has some of the positive beta environments of things like equity long short and fixed income strategies that sort of keep returns going, even in environments where you sort of have broad, strong asset returns. And so that has an interesting profile that's pretty compelling for a lot of advisors, and through time is pretty diversifying to things like holding bonds and stocks and gold.
Yeah. There's a couple good, if I can see them on my bookshelf anymore, because when I think of macro, I think a lot of like discretionary macro, gunslinger, Soros, like buy, sell anything. There's a few old books. So you got the Jack Schwager books, but also there's Steve Drobny books, Inside the House of Money, and his have some good global macro. You got Alpha Masters. You got the old John Train books, but those are mostly the equity crowd. There's a kind of an unknown book that's old called 2020 Vision, which was a good one. And I can't remember if Hedge Hunters had any macro in it or in. Anyway, a bunch of good stuff. But I've always loved listening to the global macro crew. It's just in my mind, it's always been one of the hardest to actually think about replicating. How do you guys do it? Give us the secret sauce. How do you guys think about the exposures? Is this similar across the same umbrella as HF&D?
Yeah, well, so it's the same. What we're using for our macro strategy is the same infrastructure, the same technology that we've used for HF&D and for a couple of years now, and it's the same basic approach that we use for all of our hedge fund replications, which in short infers the positions that managers have on by looking at the returns, the path of returns. And so historically, essentially top-down strategies for replication did that using rolling regressions. Like Sharpe actually started this with mutual fund alpha, and then Andrew Lowe in his work in early 2000s did it with essentially things like bonds and the dollar and stocks and things like that. The challenge with traditional regression approaches is that you have to have a long back end, right? You can't have, if you have 20 or 30 factors, you have to have at least that many data points or more in order to get anything that isn't a silly regression. And the good thing is the sort of quantitative techniques that exist today are actually, have improved our ability to sort of get a more up-to-date sense of how these managers are positioned. And so what we do today is we look at what is the highest probability portfolio that's generating the returns that we see in real time. Daily information, some monthly information that we look at, but we do it in the context of the portfolios that describe the returns back through time. And so we're not averaging multi-year portfolios. We're solving for today's outcome in the context of all the portfolios that have described the previous outcomes. And the reason we can do that is because managers' positions don't instantaneously flip. Like a manager, if you're managing $1 billion, like you're not going long and short bonds like one day versus the other. And particularly when you start to think about alpha indexing of like 500 macro managers, there aren't instantaneous position shifts. And so what that means is actually there's a lot of information value in the path of returns because today's outcomes are a function of today's portfolio. Today's portfolio is adjacent to yesterday's portfolio, and you can see the outcome of yesterday's portfolio and yesterday's returns. And so if you think about it, there's actually not that many adjacent portfolios that describe today's outcome, yesterday's, the day before, the day before, the day before. And so we can probabilistically infer how managers are positioned through that pretty well.
Does the macro fund often or not often, I don't know the answer to this, look similar to the hedge fund overall fund, or do they often kind of diverge a little bit?
For context, the sort of, let's say the correlation between the overall industry and macro is kind of 0.4, 0.5. So it's not, they're related to each other, but they're certainly not significantly related. And that's part of the reason why macro is really, a pretty compelling alpha return to add to a portfolio, because it has a modestly positive beta or correlation to stocks, to bonds, to gold, to industrial commodities or extractive commodities. It's kind of modestly related to everything, which also means that it's a pretty good diversifier, assuming you can get access to it at, a low fee and at a at a high enough target return for it to make sense to add.
I want to come back to that fee comment in a second. Well, let's say somebody's got a traditional portfolio. All right, so this and this, and they say, all right, I got like 60-40, and I got a smidgen in foreign stocks, but not really the global market portfolio. I don't have much in tips or real assets. How should I think about these four, Bob? Should I just buy all four of them with 10% each, or should I think about these in a different way? What do you say to that, advisor?
Well, in general, I think simpler is better.
You say buy 25% in each, and then just sell everything else.
Simpler is better. And usually, what we when we talk to advisors, we basically say, look, if you're just trying to figure out what's a good strategy that can add some diversification to your portfolio, and particularly give you a little bit of defensive positioning if the markets get to that point, just add the global macro strategy to your portfolio as a starting point. Now, we could go, because it is like that sort of nice all-weather, flexible alpha return that does well through the cycle. And of course, I could spend a lot of time carefully describing why a more sophisticated or complex portfolio is like slightly better than that, with a little bit of trend and a little bit of equity long short and stuff like that. But the reality is, like, most investors, most allocators are meaningfully under diversified. And so you can kind of overwhelm them with, here are all the different options that are out there. And what I like to do is basically say, look, when you present me your traditional 60-40 portfolio, I say there's two things that you got to do, which is one, buy some gold, and two, buy some diversified alpha, say macro, as a good starting point, and put 10% in each. And at least you're getting the process started to getting to a more diversified portfolio without necessarily having to take on too much tracking error. Because, that's a real thing, is that, advisors don't want to be too extreme in terms of their diversification, because then, they might experience a lot of peer risk in an up equity market environment.
And where else what other fund are they going to get exposure to cattle futures? I mean, come on, listeners, like, you don't have that in your current fund, that's for sure.
I had a client ask me about live cattle recently, and we started talking about the implications of the fact that the herd is at its lowest level since the 50s, which is something that you would have no idea about if you didn't see what these managers were doing and then go poke around and figure out why they were doing it, why they were having their long cattle positions on right now.
One of the key theses that you have, which I believe, kind of was the inspiration for launching some of these strategies, was this cost topic, and I mean, we have articles and posts going back 10, 15 years talking about just how much of a high hurdle 2 and 20 is. And people, I feel like in the private world, they get marketed this idea, this belief that you're going to magically end up in the top quartile. Therefore, there's huge dispersion in private. Therefore, this is like the land of, like, this is like Valhalla. This is like, this is where you end up, and everything is going to be happy and wonderful. But you try to run the math on 2 and 20, and it is such a massive fee drag. So maybe talk to us a little bit about kind of what you guys think about there and how you guys are managed to do this for lower.
Yeah, and what I'd emphasize, it's not just the fee drag, it's also the tax drag that a lot of these strategies have for anyone who is a taxable investor. And so, if you think about it, just a very, very simple example, if let's say you have a 10% gross of fee return that exists, which is a normal 2 and 20 type strategy, gross of fee target, particularly for things like hedge funds. Well, if you're charged 2 and 20 fees, that takes away roughly 4%, give or take. Okay, so now you're down to 6. Now, Uncle Sam is taking 3 because he's taking 50% because you're being charged in an LP structure often at your marginal income tax rate. So now we're down to 3. Then usually your advisor's picking up 1, and there might be some fees on top of that related to getting access to these strategies. So say you're down now about 1.5, another 1.5. Now you got 1.5% return for something that, you're the one taking all the risk. And like everybody is getting paid. The manager's getting paid, Uncle Sam's getting paid, your advisor's getting paid, the platform is getting paid, everyone is getting paid, and you are taking all the risk. And that is insane, right? And so when you start to think about like, how do you change the economics of these strategies? Because, a 10% returning strategy with low correlation to the rest of your portfolio, that's a great strategy. You want that in your portfolio, right? If you can get access to it. And so how do you change the mix? Well, there's a couple of key levers that you can do. First of all, you can change the target return to be higher, which essentially makes it more cash efficient. That's a good starting point. The next thing you could do is reduce the fees. From our perspective, what we're trying to do, my goal, my long-term goal is 1/10 the fees. We're not quite there yet at our current scale, but that's my goal, is 1/10 the fees. Right now at our 2X strategies, essentially we have a quarter of the fees run at twice the target return. So we're close. We're not quite there, but we're close. Put it in an ETF wrapper, which meaningfully increases the tax efficiency. So now instead of ordinary income, you're paying, either capital gains or a dividend. So now you're at, about half the taxes. And then put it into a structure where you don't have to go through a platform and the docs and basically pay all those additional fees, where basically in any platform you can get access to it. And so you take away some of those platform fees, implicit or explicit. And now we've transformed something that, typically would look like a 1.5-2% net return on a 10% grossing strategy. And instead, what you have is say a 20% grossing strategy with 95 basis points of fees and 25% taxes and, essentially no platform fees. And now we've totally changed. We've created a strategy that is pretty close to that 10% net return, right? With low correlation, net of fees, net of taxes, net of other fees. And we've created something that's a 10% returning vehicle with low correlation to the rest of your portfolio. And that is a radically better option for investors than, what had existed before.
It's interesting because if you look at the world, and I tweeted out something today, I saw, this big money institutions, and Yale was kind of the inspiration here. I mean, look, we wrote a book on this topic a long time ago, but we got Mercer, typical Mercer endowment allocation, Nakubo over $5 billion, just between private equity and private real assets, 50% in private credit, 50% average, which is kind of an astonishing from 2 standpoints. One is, those aren't probably at your fee level, and 2, they're illiquid, which to me is and Mercer then breaks it out into 10 plus year liquidity, 5 to 7 year liquidity, and Nakubo $5 billion plus has got half in that 5, 7, 10-year plus liquidity bucket, which to me was like, they got into a huge problem back in 08, 09 with illiquidity and got upside down when all of a sudden the privates are like half the endowment because everything else. So anyway, but here we are in the cycle where you start to see a lot of stories where they're like, you know what we should do? We should let 401ks invest in illiquid assets. And this is always conflicting for me because in general, I'm like, look, investors can trade meme stocks, they can trade pink sheets, they can buy 0-day options, they can bet on prediction markets on if Jerome Powell is going to say good morning. But because of the accredited investor rule, they can't invest in this, that, and the other, startups, yada, yada. But on the same time, I log on to Instagram and I look at these like clearly predatory private, they're all private, they're almost always real estate, promising 20, 30, 50% returns. Sometimes it's monthly, by the way, not per year, like we're 20% per month. And on the flip side, I'm like, oh God, we should have access to nothing, actually. How do you think about, like, how do you look at this, solve this for me, this dilemma? Because depending on the day, I wake up thinking it's a good idea or a terrible idea, or I just give up and it's too hard. We're all going to be gamblers.
Well, I think the main question is whether the investors in these products have essentially parallel or equal access to information as others involved in it. So if you're trading, 0-day options on the S&P 500, like, basically everyone has access to all the information. It might be an imprudent strategy. It might be silly. It might be degenerate gambling. That's okay. Like that, I don't necessarily have I wouldn't recommend someone doing that, but I don't think that there's a real sort of risk of being taken advantage of as a function of that. Now, I think the challenge we see as we start to look at some of these private vehicles, then moving into the 401k structure, is will investors have access, easy access to similar information as people who are, as others who are involved in this? So a simple example is like, this actually exists already with the PRIV ETF, which has the Apollo private credit, possible allocations. Like, how do you know whether the allocations that are going into those products that are being sold to the 401k buyer are, on par with the same quality as the assets that exist in the private fund vehicles that these issuers are creating? Or even worse, how do you know that they're not dumping the garbage that exists in their private vehicles at elevated prices to 401k investors? If you can't make a clear assessment of that, which I would emphasize, like the average 401k investor cannot do that, cannot make a reasonable assessment of the quality of those products within a reasonable amount of time, then those products should not be offered because they create the risk that they're being taken advantage of. And I think, what you see is, that's my biggest concern about this stuff, is that the institutional asset allocators have all of the incentive in the world to stuff crap into these products being sold to retail and enrich their institutional clients, because the institutional clients pay the big fees, the retail pays the smaller fees, maybe I should say. The institutional clients are first movers and are looking carefully at the assets. The retail is not looking carefully at the assets, and that imbalance is unacceptable. And that's literally, when you go through an SEC review process, like that's what they care about. Like, is the everyday investor going to experience an imbalance, I should say, the SEC before this administration? I can't speak to this administration. I haven't been through an SEC review in this one. That's what they're really focused on, is there an imbalance of information? And odds are more likely than not that with these new products, there is that imbalance.
So much of our world comes down to this question of like, just because you can do it doesn't mean you should, there's a certainly an element and something to say for simplicity, like you mentioned. And a lot of these don't really fit under that. Like, we've run into this problem many times before where we'll see someone launch something and be like, there's no way people understand this, that, you're kind of opting into. If you buy it on your own, God bless you. Good for you. Any other thoughts on kind of the institutional space? It could be endowments selling secondaries. It could be any other weird structures. I mean, we've seen a lot of, you mentioned PRIV, there's some DXYZ, there's been all sorts of kind of weirdo stuff going on. Any thoughts?
There is this broad push to figure out a solution to illiquid assets in liquid structures. And I actually think in some cases, like the sort of end goal of that is probably a good goal, which is like, we probably should have an ability for a broader set of investors to be able to access these strategies, things like venture capital, private equity, et cetera. That's okay. I mean, okay, meaning they could plausibly benefit from it. I think the challenge is, how do we create the right structures so that they're not getting screwed with negative selection and high fees and unexpected illiquidity? So like you think about something like, interval funds or funds like that, where people expect liquidity and then it may or may not be there at the time that they expect it, right? And so from my perspective, there's a lot of promise, and it's something I've been working on a lot, is how do you transform these illiquids to liquid products, but in a way that is low fee and helps deal with that negative selection bias problem. Because if what we could do is we could say, hey, every investor in the world, here's access to top quartile venture-backed companies at 95 basis points of fees and daily liquidity on a secondary market, well, actually, that would be great, right? That would be great for a lot of investors. That would radically challenge the whole industry. It's just there's a lot of work to get from where we are today to that point. And the problem is, a lot of the first movers in this space have been grifters. And that is really a challenge. Like, for those of us who are not grifters, who are actually trying to deliver something that that looks like low cost indexing in 2 and 20 with liquidity, we basically face an uphill battle because folks like DXYZ, engaged in deceptive marketing practices and are charging 600 basis points and lying about it in their marketing materials. And so that's the struggle that I have, which is, it seems like everyone out there who has tried this so far is trying to screw the investor, and those few of us who are not trying to screw the investor face a heck of an uphill battle as a result.
I feel like, does bear market help? Does it clean out the grift? Because our buddy Economic had a funny poll today where he's like, grifting is more prevalent in blank right now: politics, finance, crypto, influencer, social media, wellness, health. And by far the biggest winner was politics. I think I voted finance, crypto, but you see it kind of everywhere. Do we just need a nice bear market? I feel like the word cloud of shame or couth or decency, it's like, it's a strange thing to see certain people in the grifting world who are already rich, who have plenty of money, continue to do things of very questionable morality. And it's kind of like, why?
Ultimately, people will hope for the best until faced with the reality of these grifts underperforming, right? And so nothing instills discipline like loss, and that's unfortunate, because part of what we're kind of supposed to have here is a regulatory environment where somebody is looking out for the everyday investor and making sure that, folks aren't engaged in deceptive marketing practices or deceptive claims. And I don't know what's going on. Like, FINRA seems to be fine nitpicking my icons on my fact sheet to no end, when we've got people out there, for instance, running crypto companies, making certain definitive claims that crypto prices are going to move up to, Bitcoin's going to move to millions of dollars in the future. And like, what is going on with the regulatory environment here? Like, it's total nonsense that you have these people making obvious deceptive marketing, engaged in obvious deceptive marketing practices, and you're like, out there harassing small scale ETF investors. It doesn't make any sense.
You hit a funny bone. And so I don't even want to go down this route because I spent so much time jabbering about this, where we've posted a lot of these on Twitter. We have this running Instagram thread of, people talking about these 50% returns. We had some where I look at it and I'm like, how can you possibly say this? Like, how is this something that you can say out loud? And I was joking today, again, just talking about this, but I was like, we should just hire a couple analysts, let them be AI assisted and just run through and whistleblow all these, terrible ones and get the filings in. But I don't know. It's, I kind of hope it gets washed out in the next cycle.
Yeah. I mean, so far it seems like, nothing's being done about it. I run into these things with some occasion and do various reporting of it. And, as far as I can tell, no one is being held accountable for these deceptive practices. And unfortunately, the people who are ultimately paying the price are the everyday investors who get hooked by these things. One of the things that I find compelling about the ETF community is that, like it or not, there's not a lot of there's a lot less opportunity to engage in deceptive marketing practices than pretty much all the other different ways it can be done.
I mean, usually it gets called out quick. I mean, I posted one on Platinum Equity or something that was talking about a guaranteed, and guaranteed, as you know, is like the giant red flag, guaranteed 12 or 15% dividends, and it turned out to be a multi-$100 million fraud that got shut down. Sadly, I didn't whistleblow it, but we wrote one about Tai Lopez, which is a famous kind of internet entrepreneur, and he had an ad where I couldn't even understand what the ad meant, and I posted it on Twitter where it said, "Did you realize for every $300K invested in our preferred dividends, we will send you $60K a year in monthly payments?" And I'm like, I don't even understand what this means. Like, what do you mean investing in our preferred dividends? And like, what do you mean you're going to send me $60K? I'm like, that's a pretty good yield. Also, what are you even talking about? Anyway, so there's a lot of that. But buyer beware, listeners.
This is what, after a few cocktails at Exchange, this is what we all talk about is the pain that comes from being a listed, issuing listed securities that are being constantly reviewed by FINRA, and looking out in the rest of the world and seeing how essentially you get away with damn near anything if you're not in our little corner of the market.
And shout for Exchange listeners, if you're going to Future Proof, as always, we'll do our Monday morning surfing for free lessons if you guys are willing to get out of bed that early. And of course, Monday Night Football, where at HQ Gastropub, where you got to RSVP. Last year, I think capacity was like 400 and there was a line around the block. So make sure you RSVP and either show up early or late. I think it's the smart way to do it. Show up in the middle, you're probably going to be waiting out the door, and you can grab Bob and I, and we'll tell you where all the bodies are buried. I know. So lots more we can talk about off podcast. Bob, what else? So as we look out to the rest of the year, 2025, 2026, as you're writing your Substack, recording some videos, what else is on your brain? Anything got you excited, confused, worried as we look out onto the horizon? And you can give us a glimpse into any future fund launches, anything you're writing about, anything you're doing. Tell us all of it.
Yeah, I mean, I think from a macro perspective, I think part of the process in the course of the second half of the year is going to be, keeping your head about you at a time when, there's a divergence. There may be a divergence or continued divergence between, equity prices and the real economy. And so that if you've been through a few cycles as a macro investor is one of the more challenging times, and you just have to stay disciplined, keep your eyes on the macro data and recognize that over time that's gonna play out, which, every day coming in with a fresh perspective and seeing whether the data and the dynamics are affirming that picture or challenging it is essentially what what I do every day and talk about in the various places where I'm either writing or talking. From a company perspective, I think I'm very excited to go out and talk to folks about these new products. I've been very happy with the amount of traction and interest that we've gotten from a wide variety of different advisors. I think these 2x hedge fund strategies are really they're hitting. When you feel that product market fit, when you start to talk to 10 advisors and they're all like, yeah, I get why this would make sense. That's a good feeling. And so it's nice to be able to do that a bunch and sort of broaden our perspective. And for me, the next frontier is this work on what I'm calling liquid venture, which is really trying to upend. We've already focused on upending the hedge fund industry with what we've done, and now focusing on how do we do the same on the venture side of the world.
Yeah, I mean, I would love it, man. Look, both the VC and PE, a lot of academic literature talks about being able to replicate those at a much lower cost and liquid environment. So I'd be excited to see those. I got some good ticker ideas for you. We can circle on afterwards.
Yeah, let's do it.
Yeah, very cool. Bob, thanks so much for joining us. Substack, Wandering Around the Neighborhood. Where do we find you?
You can find me on pretty much every social at Bobby Unlimited on the handle. And if you're interested in a deeper dive on macro, some real, day-to-day macro data nerd work, you can check out my new Substack. It's under my name, or Non-Consensus is the title of the Substack. And for more on our products, which is essentially my day job, check out unlimitedetfs.com, which, has been subtly in the background through the course of this conversation.
For those watching on YouTube, Bob, thanks so much for joining us.
Thanks so much for having me. It was great.